There is a theory in chaos mathematics called the butterfly effect. It posits that a butterfly flapping its wings in Tokyo can cause a tornado in New York in the high-stakes world of global finance. This is no longer just a mathematical theory. It is a cold, hard mechanical certainty. While the mainstream media remains pathologically obsessed with the Federal Reserve's next move, the theater of the U.S. election cycle, or the latest geopolitical skirmish in Venezuela, they are blind to the single most dangerous chart in the history of modern finance. This chart has just shattered a 25-year trend, signaling the absolute end of the free money era. I am talking about the Japanese government bond yields, specifically the 30-year yield, which has just surged to a staggering 3.5%. To the average person, these are just boring numbers on a screen, but to the institutional plumbing of the world, this is a catastrophe. For 2 decades, Japan has acted as the global ATM, printing unlimited yen and keeping rates at zero. But today, that ATM is not just closed, it is demanding its money back. The yen bomb has detonated, and the timer just hit zero. To understand why 3.5% represents a global disaster, we must pull back the curtain on the game Wall Street has been playing since 2001, known as the yen carry trade. Imagine you are a veteran hedge fund manager in New York. You want to buy Nvidia, Bitcoin, or US Treasuries, but you don't want to use your own capital. You want leverage. You look for the cheapest loan on the planet, and you find it in Japan, where the Bank of Japan has maintained interest rates at zero or even negative for years. You borrow 1 billion yen at virtually no cost, convert that yen into US dollars, and buy assets yielding 5% or 10%. You pocket the difference as pure profit. This free money engine has pumped trillions of dollars into Western markets, acting as the primary liquidity driver for the massive asset bubbles we see today. However, this entire mechanism relies on one fatal assumption, that Japanese rates will stay low forever. That assumption has just evaporated. The Bank of Japan has officially lost control as inflation forces them to tighten their grip. When the 10-year yield crossed 2.13% and the 30-year hit 3.5%, the golden number was breached. Japan is a nation of savers, with massive pension funds and life insurers that have been forced to invest offshore for decades because they couldn't find yield at home. They are currently the largest foreign holders of U.S. debt, owning over $1.2 trillion in treasuries, but now they can get 3.5% risk-free at home in Tokyo without any currency risk. The Great Repatriation has begun. Japanese investors are selling their U.S. bonds and pulling their capital back to Tokyo. This creates a massive liquidity vacuum in the heart of the Western financial system. When the largest buyer in the room leaves, the floor falls out, and that is exactly what we are witnessing right now. This is not merely a Japanese crisis. It is a global margin call that is about to ripple through every asset class. When the yen strengthens and Japanese rates rise, those trillion-dollar carry trades become toxic. Hedge funds that are over-leveraged must sell their winners, their U.S. tech stocks and their crypto, just to pay back the yen they borrowed. This creates a wave of mechanical selling pressure that has absolutely nothing to do with economic fundamentals or corporate earnings. We are entering a deleveraging event that will expose the shadow casino of the global banking system. The notional value of global derivatives tied to interest rates is estimated to be near $1 quadrillion. Most of these are bets that rates would stay stable. As Japan pushes global yields higher, these derivative bets are blowing up, creating a credit contagion that will force the Federal Reserve into a desperate corner. The United States government is currently running a deficit of $2 trillion a year, requiring a constant stream of foreign buyers to keep the lights on. But with China selling and Japan repatriating, the U.S. Treasury market is facing a terminal collapse. To prevent interest rates from spiking to 7% or 8%, which would make the U.S. government insolvent, the Federal Reserve will be forced to implement yield curve control. They will have to become the buyer of last resort, printing infinite new dollars to buy the old bonds that Japan is dumping. This is the ultimate surrender. It means the central bank has prioritized the solvency of the government over the value of the currency. Once the market realizes that the supply of dollars is going vertical to save the bond market, faith in fiat currency will vanish. This is the precise moment when capital flees from the leveraged paper economy and into the real economy of hard assets. Silver is the primary beneficiary of this systemic shift because it sits at the intersection of monetary history and industrial utility. Unlike a treasury bond or a bank deposit, silver has no counterparty risk and cannot be diluted by a central bank printer. In the initial phase of this liquidity shock, everything gets sold, and we may see silver prices dip as traders cover their margin calls. But once the smoke clears, the rush for safety will be unprecedented. We are looking at a dual driver for silver: the Fed's desperate printing to absorb Japanese selling, and a surge in industrial demand from a manufacturing-heavy Japan that now has a stronger currency to buy raw materials. This is not a speculative rally, it is a monetary flight to quality. We are repeating the cycle of the 1970s, where bonds crashed and precious metals went to the moon. But this time, the debt levels are 10 times higher and the exit door is much smaller. The yen bomb is the pin that has finally popped the global debt bubble, marking the definitive end of the era of cheap money. We have moved past the point of speculation and into the era of a violent global repricing. History gives us a clear roadmap for what happens next. In every major crisis, from 2008 to 2020, the response has always been the same: massive liquidity injections. When the Fed eventually surrenders to yield curve control to save the banks, silver will not just rise, it will explode. We have established conservative price targets based on the gold-to-silver ratio compression. At a $4,500 gold price, a return to the historical ratio of 41 puts silver at $112. In a true panic, similar to the 1980s, that ratio could collapse to 15:1, sending silver toward $300. However, you must be prepared for the journey. The path from $70 to $300 will not be a straight line. It will be a jagged, violent trajectory filled with shakeouts designed to scare you out of your position. The smart money wants your physical metal so they can cover their paper shorts as the system breaks. Do not let the volatility of the carry trade unwind steal your future. If you own the metal and avoid leverage, you can ride out the storm while the fiat system burns. The yen is moving, the bonds are breaking, and silver is the next domino to fall. Hold fast, because the great repricing has only just begun. The global ATM is out of order, and the only currency that will matter is the one you can.
While you were enjoying the warmth of your family on Christmas Eve, a life and death chessboard was flipped on the other side of the globe. Washington has just made its most reckless move in a decade. The U.S. Navy forcibly boarded a Chinese-linked vessel in international waters to tighten the noose around Venezuela. The reaction from Moscow? Vladimir Putin did not hesitate. An emergency communique from the Kremlin was just released, affirming that Russia will protect Maduro at any cost. Meanwhile, Beijing remains silent. But in the world of giants, China's silence is the sound of a tsunami building offshore. All of these events are converging toward a single explosive point that no one on mainstream television dares to mention: the silver market. Why would a naval skirmish change the value of the assets in your pocket forever by tomorrow morning? Why, as superpowers draw their swords, does the silver price on your chart sit suspiciously still at $71.94? I am a financial investigative journalist, and tonight I will expose a conspiracy. Smart money is weaponizing this chaos to orchestrate a raid on the global financial system. We are entering Ghost Week, where an $8 price gap is waiting to wipe out the naive. Don't look away from the screen. This is no longer a forecast. This is a forensic field investigation into the largest liquidity explosion in modern history. Let me explain why the silver price has been eerily flat for the last 24 hours. In the world of hedge fund management, we call the period between December 26th and January 2nd Ghost Week. Think about who controls the market on a normal Tuesday. It's the senior risk managers at JP Morgan, the head traders at Bridgewater, and the elite algorithmic desks in London and Hong Kong. But right now, they aren't there. They're skiing in Aspen or lounging on yachts in St. Bart's with their families. They've powered down their terminals and handed the keys to the castle to a skeleton crew. Junior traders, interns, and maintenance algorithms running on low power mode with one single instruction: do nothing until the boss gets back in January. This creates a lethal phenomenon, the liquidity vacuum. Trading volume drops by 90%. Imagine the silver market is a room filled with gasoline fumes, but no one is standing guard. On a normal day, the ice protecting the market is 10 meters thick. A billion-dollar sell order barely leaves a scratch because thousands of limit orders are waiting underneath like a safety cushion. But during Ghost Week, that ice is paper thin. The walls of buy orders have been pulled. If a massive buy order hits the tape tomorrow morning, perhaps from a Chinese sovereign wealth fund seeking retaliation for the US blockade, the price won't tick up, it will teleport. It will gap from $72 straight to $80 in 60 seconds. Why? Because there is no one there to sell to them. The sellers are busy opening Christmas presents. Now, let's connect the logical dots they don't want you to see. Silver isn't just jewelry. It is a war metal. When the US boarded that Chinese ship, they triggered a chain reaction. The macro algorithms of the world's largest funds are programmed with one ultimate command: sell risk, buy havens. Usually, the US dollar is the haven, but look at the DXY, dollar index. It's at a 12-week low. Why? Because the dollar is the very weapon being used by the US to enforce the blockade. The world, led by the BRICS bloc, Moscow, and Beijing, no longer trusts the dollar. They are hunting for an asset that cannot be frozen and cannot be printed. That asset is silver. Then comes the knockout punch. The Federal Reserve has officially waved the white flag. Governor Christopher Waller admitted that inflation is stuck at 2.7%, yet they are still forced to cut rates. Why would they commit economic suicide? Because the $36 trillion US debt is so massive that if they don't lower rates, the government defaults instantly. This is the most terrifyingly bullish signal for silver I have seen in my career. Silver thrives in an environment of negative real rates. When you hold dollars, you are losing purchasing power every second. Smart money knows this. That is why the dollar index is collapsing during the holidays. They are fleeing the dollar before the new year even begins. On December 23rd, just before the holiday break, a silent raid took place at the COMEX vaults. 1.4 million ounces of silver at the Asahi refining vault evaporated overnight. You can print more dollars, but you cannot print 1.4 million ounces of physical silver. Look at the scale. A total of 2.2 million ounces of liquid silver left the system in just 24 hours. Why does this matter for Ghost Week? Typically, when the price hits an all-time high of $71.11, inventory should increase because people want to sell and take profits, but the opposite is happening. The price is at the ceiling, but the vaults are empty. This is the textbook definition of a cornered market. The entities withdrawing this silver don't care about a price of $72 or $75. They are terrified that by January there will be no silver left to own. They are pulling physical metal out of the system to ensure the survival of their technological and military supply chains. And here is the anchor for the price. Silver in Shanghai is currently trading at $77, while New York is at $72. That $5 spread is a massive magnet. Tomorrow, when the New York market opens with razor-thin liquidity, the Shanghai magnet will pull New York's price vertically. Any attempt to push the price below $70 will be devoured instantly by arbitrage bots. Do not let the stillness of tonight fool you. The silver market is a coiled spring compressed to its absolute limit. Tomorrow morning, December 26th, when the opening bell rings, we will witness something unprecedented. I am forecasting a gap up of approximately $8. We could see silver open at $80 and never look back. A final warning: if you are using high leverage, stop. During Ghost Week, the market can whip down to $68 for 1 second to liquidate your account before skyrocketing to $80. Don't get left behind because of a technical tremor. 2025 was just the tutorial. 2026 is the boss level, where silver inventory runs dry, where the BRICS currency is born, and where the Fed officially surrenders to inflation. Hold on to your physical ounces. Do not sell early. Do not let Moscow, Beijing, or Washington steal your position in this game. Be the intelligent observer, follow the footprints of the smart money, and enjoy your holiday with the confidence of someone who has seen through the matrix. Don't forget to like and subscribe for the most urgent investigative reports on global capital flows. Tonight, I am delivering an exclusive investigation into a systemic collapse, or a life-changing opportunity, depending on which side of the barricade you stand. We are on the precipice of an event I call the liquidity massacre. While the world sleeps, a trap has been set by the smart money, and tomorrow the jaws begin to close. This is not just a market report. This is a forensic analysis of the disappearance of trust and the violent return of physical reality. Tomorrow morning, December 26th, the world will wake up to leftover turkey and post-Christmas sales. But in the shadows of the global commodity markets, a black hole of liquidity is forming. While the big institutional traders at the desks in London, New York, and Singapore are skiing in Aspen or lounging in the tropics, the silver market, the very nervous system of modern technology, enters what we veterans call the Ghost Week. Look at this terrifying paradox. Silver just closed at $71.94 per ounce. That is a staggering 149% gain in a single year. Any sane observer would expect a correction, but instead of a retreat, we see an eerie silence. Trading volume has evaporated by 70%, yet 145,000 futures contracts are still hanging in the air like unexploded ordnances. The crowd thinks the market is resting. They are wrong. The market never sleeps. It only becomes empty. And in the world of high-stakes finance, a vacuum is never stable. It is filled with violence. A liquidity vortex is swirling, and the most critical factor, the one no one in the mainstream media is telling you, is that while the West is asleep at the wheel, a gargantuan force from the East has already pulled the pin on this grenade. If you follow the money, it leads to a chilling realization. Those 145,000 contracts on the COMEX aren't just digital blips. They represent 725 million ounces of silver. To put that in perspective, that is nearly the entire annual mining production of the planet. Who holds these positions? And why did UBS, one of the most powerful banking entities on Earth, casually use the word unhinged to describe this price action? The answer lies in the massive premium gap between New York and Shanghai. While retail investors in the West are distracted by green and red candles on their phone apps, the Shanghai Gold Exchange is trading silver at a premium of over $5 per ounce higher than the global spot price. This is a massive industrial vacuum. China isn't just buying silver, they are running an industrial-scale suction machine, draining every available ounce of physical metal from Western vaults in London and New York. My investigation shows that silver inventories in Shanghai have plunged to 10-year lows. Why do they need this much metal right now? Because they know something you don't. On January 1st, Beijing is prepared to implement drastic export controls on silver. An ice wall is about to be built, cutting off the flow of silver from the world's largest factory. When the thin liquidity of Ghost Week hits the brick wall of a Chinese export ban, we don't get a standard price adjustment, we get a liquidity extinction event. Why now? Why this sudden urgency? Look at the technology. The global solar industry has shifted to TOPCon cells. These aren't your grandfather's solar panels. TOPCon requires 50% more silver paste per unit to achieve its efficiency. China controls 80% of this supply chain. They aren't just players, they own the casino. By hoarding physical silver and then cutting off exports, China is effectively taxing every Western tech company. If Tesla, Apple, or Samsung need silver for their 2026 production lines, they will have to beg for it, and they won't be paying $72. The US government has seen this coming. That is why silver was recently designated a strategic critical mineral. This is the opening act of a metal war. We have seen silver deficits for 7 consecutive years, a cumulative shortfall of 678 million ounces. We've been living on borrowed silver, draining the ETFs and the old stockpiles to fill the gap. But those stockpiles are gone. The paper silver market, which trades 100 ounces for every 1 ounce of physical metal that actually exists, is about to hit the wall of reality. In a market with 145,000 contracts and no physical metal to back them up, the price becomes irrelevant. The only thing that matters is delivery. And with China locking its gates on January 1st, the Western banks are caught in a pincer move between record industrial demand and a total supply blackout. Now, let's run the math for January 2nd. The holidays are over. Fund managers return to their desks in Manhattan, nursing hangovers and looking at their screens. They see the news. China has restricted exports. The Shanghai premium has exploded to $10. The 145,000 contracts on the COMEX are suddenly a liability of $52 billion. Every short seller, every bank that sold silver they didn't have receives a notification, the margin call. Because there is no liquidity during the ghost week, the price doesn't climb, it teleports. The resistance at $75 will be vaporized. The smart money knows that $80 is the psychological breaking point. An $8 move from our current level is not a guess. It is a mathematical certainty when forced buying meets a physical drought. In a short squeeze, the price stops when the last seller is liquidated. But who is the seller if China has closed its doors, if the vaults in London are empty? The price runs until the industrial giants, the ones who must have the metal to survive, simply outbid everyone else. This is the feedback loop of the elite. It's not manipulation, it's the structure of a broken system finally collapsing. The ghost week begins tomorrow. By the time you watch this, the trap has likely already sprung. The 145,000 contracts are frozen. The Shanghai vacuum has done its work. The ice wall is being built as we speak. My advice? Do not be the liquidity for the big banks. Do not sell into the first spike. They want your physical metal. They need your shares in the miners to cover their billion-dollar blunders. When the world asks on January 2nd how silver gapped from $72 to $80 overnight, you will know the answer. It was a forensic certainty, hidden in plain sight, driven by a global struggle for the most important metal of the 21st century. This is the moment where paper meets metal. The $8 squeeze is just the beginning of a repricing that will define the next decade. Stay disciplined, stay skeptical, and above all, watch the vaults. Because in this market, if you can't touch it, you don't own it. I will see you on the other side of $80.